Worrying signals from the world's second largest economy. Investment plunging, factories slowing, home prices sinking, and consumers are still on strike. Could the latest economic data be bad enough for Beijing to unleash stimulus? Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Equities extending losses as uncertainty over Fed rate cuts and stretch valuations in technology stocks weigh on sentiment. Morningstar Investment Management's Apex CIO Matt Wacher will be joining us with his take on the market action. And as India's financial sector draws growing interest from foreign investors, we speak to the MD and CEO of the recently listed Piramal Finance.
And I'm Stephen Engel in Shanghai at the 20th anniversary of the Citi China Conference. A slew of guests, of course, all morning. We're going to cap things off this Friday. Coming up after the break, we're going to talk about China and Asia. Our next guest is overweight China equities. We'll get into the reasons why. Despite some of those negative numbers, Haslinda, you just talked about, Lucy Baldwin, Citi's global head of research, is coming up.
Asian markets trading lower after data showing China's economic activity cooled more than expected in October. Retail sales gained 2.9%, slowing for a fifth straight month in the longest such streak in 4 years. Other categories, including fixed asset investment and industrial output, missed estimates, while the decline in home prices also worsened. Now, China's economic activity cooled more than expected in October, with an unprecedented slump in investment and slower growth in industrial output adding to a drag from sluggish consumption. Let's bring in our China correspondent, Min Lo. Min, break down the numbers for us. What stood out? Because just when you thought that China's economy was stabilizing, it's now not so.
Yeah, actually, the numbers were really pretty disappointing and beyond worse than expected, I would say, and especially the fixed asset investment declining by about 1.7%, I believe, compared to a decline of 0.5% the previous month. That is a big contraction there, and it shows you that perhaps all the different three components of fixed asset investment, property, infrastructure, private investment, all showing weakness there. And this is concerning given that the government has been injecting at least 500 billion yuan in stimulus for policy banks in a new financing toolbox to try to expand investment, and yet those sentiment are still very weak there. And the other thing to point out is retail sales as well. 2.9% was slightly better than expected, but this is the weakest print in more than a year and the fifth straight month of deceleration, which is the longest in 4 years. You look at industrial production as well, a big decline there compared to the previous month. It increased by about 4.9% compared to 6.5%. But bear in mind, that is below the 5% mark, which economists say is very worrying. A part of it is maybe not too unexpected because we got the export numbers earlier this month for October was unexpectedly slow. So no surprise that industrial production would be affected. But below 5% shows you that domestic demand is also weighing heavily on that.
What does it all mean for policy stimulus implications? We know that China has been keeping its powder dry.
Yes, and because we are so close to the end of the year, we have gotten the GDP numbers so far. It's on track to meet the growth target of around 5%, which means that there really is no urgency for the government to do more to boost growth this year. So expectations are low in the coming months, but we might have to wait until perhaps next year, March or April. Maybe that is when we could see a little bit more stimulus. Economists are already pushing back their forecast for any rate cuts or triple R cuts to first quarter of next year. And you add to that, right, we also have the home prices data out today, declining by about 0.45% on month. And you combine that with the home sales data in October was down 40%. It shows you that the home prices steadily throughout the year has been on the decline despite all the measures from the government so far. So I think the consensus on the street is that yes, more stimulus is needed. The question is when, and it seems like there is no urgency right now.
Not yet again. Min, thank you so much for that. Bloomberg's China correspondent, Min Lo. Let's get more perspective on China with Matt Wacher, Apex CIO of Morningstar Investment Management. Matt, good to have you with us. First of all, your reaction to the data out of China. We know so far there's been a divergence when it comes to, the markets and the economy.
Yeah, well, certainly the markets have done very well in China this year, despite kind of the last few months, some of the data really disappointing. I think that really we would see that there's still a few opportunities in China, despite the rally that we saw in markets and despite this kind of macroeconomic noise that we're seeing. We think that valuations really at the start of this year were still very depressed in China, so stock valuations. And we think that there's probably still more valuation expansion, if nothing more, that can happen. We think that there's in particular areas, the tech sector, for example, it's done very well, but there's a few catalysts that can, a slight turnaround in consumer sentiment or retail sales, and also, if you get any more, if the AI theme has more legs, although that may be in doubt, as we've seen in the US over the last couple of weeks. If the AI theme does have a few more legs, we think stocks like Alibaba, Tencent can continue to do very well into the medium to long term.
Matt, your reaction is in line with the rest of the markets. You're pretty much shrugging off the weak data we're seeing out of China today. At what point will this data mean something and translate to reaction response in the market?
I think the key risk is that and it's obviously been the key risk for quite some time in terms of especially the sectors that we want to play in China. The Alibabas, the JDs, we saw JD report, and that was taken very badly. But it's really down to the consumer. If the consumer does come back and start to spend, then that's what's really going to drive. Consumption is key for some of the stock thesis that we have to play out, and that's really what we need to see. If we continue to see retail sales, consumer confidence drift off, and not meet expectations, that's when you're going to. We've probably got a month or two left before people start to really downgrade some of the earnings expectations that they might have for some of these stocks.
So, Matt, stick with China AI plays. Is that basically the stance you take?
We think just based on a valuation basis, we think that some of the China tech stocks, although they've done very well, still reasonable opportunities purely on valuation.
What's the risk to that? That's
the risk to that is that
risk,
they don't meet
that.
Oh, yeah. I mean, obviously we want to make sure we have a much more diversified portfolio than just an allocation to China tech stocks. And we're multi-asset investors. We invest across a range of different asset classes. So and a range of different jurisdictions. But where we want to invest in China, that's the way we're playing it at this point in time. The risk is really, as I said, the consumer not coming back and spending in China, and that really earnings expectations aren't met. We saw a bit of that with JD today.
Matt, people draw a distinction when it comes to AI investment in China and the US. They say for China, it's more use cases. For the US, it's mainly hype. Do you agree?
Look, I think that both have use cases. Certainly, I think that there is a bit more hype in the US, maybe it's more around just there's a little bit more speculative behaviour we'd notice. I don't know that it's a bubble, but certainly valuations are much higher at this point in time. We've certainly seen in the past that China equities can be quite speculative as well, but that speculation, that hype seems to be playing out in the US. I don't think that it's necessarily specific to the AI trade, that's just the focus at this point in time. I think that we can see, and we have seen over the last few weeks, some of the heat coming out of the market. There's potentially a longer period of kind of, stagnant returns from the AI sector in the US as it catches its breath. I'm not saying that they're all terrible companies. They're amazing companies in the US, but there is a bit of hype around them at this point in time.
We have a headline out of China from the National Statistic Bureau saying that the real estate market adjustments will take some time. And therein lies the problem in the Chinese economy. It is real estate. How much of a risk is this to all the predictions, assumptions you're making about China?
I think that again, if real estate remains depressed in China, and it will take some time, we would agree with that. If it remains depressed, that just affects confidence, it affects consumer confidence, business confidence. And so that just means any recovery in China is just much more elongated. So we want to be very selective in the stocks that we own there. And we want to build a robust portfolio around that. We think that there is opportunity in China, but there's certainly a lot of risk there as well.
It seems like the AI trade is not the only trade in town, because when you take a look at the Chinese market, it's pretty much driven by bank shares as well. When the macro environment isn't looking too great, people gravitate towards yield. Is there still room to run for bank shares in China?
We think that we're trying to steer clear of bank shares in China at the moment. There's still quite a few unknowns out there, the real estate sector and those sorts of things. We're not purely playing the tech names for the AI trade. That's kind of an added benefit, I guess. We think that that's really around the consumer and consumer confidence coming back. We'd agree that the consumer confidence needs to be enhanced for that as a catalyst for those trades to play out. But we're certainly steering a little bit away from the financial sector, the banking sector at this point in time. And we've been reducing our global weight to financials as well, not just in China.
What are the underappreciated opportunities in China, you think?
I think that it's getting more difficult to find anything that's of really great value. Certainly, where we're playing in sort of some of those tech names, they were very underappreciated this time last year, and sitting on amazing valuations, and you could really buy into some of those bigger tech names at valuations that were very, very compelling. I think as the market has rallied across the board in China, it's become more risky, full stop, and susceptible, if we do get this macro environment doesn't improve, susceptible for a reasonably large correction. So we think that it's very difficult to we want to really focus on where valuations are most compelling, and that's getting harder to discern at this point in time. We think there's still a little bit to go in some of the bigger tech names in terms of valuation, but overall, China equities have had a pretty good run.
Matt, hang tight. Matt Wacher of Morningstar Investment Management is sticking around. Now, still ahead on Inside, our exclusive interview with Citi's CEO Jane Fraser. Hear her views on the trade truce, why the bank is on the front foot in China, and her economic outlook for the year ahead.
I don't think we're out of the woods yet, and there's a sense that there may be another shoe to drop. It could be in tariffs or in the labor market, it could be in the asset prices that are quite high in the States. But all of that said, we're quite optimistic about 26.
Minneapolis Fed President Neil Kashkari says he did not support the central bank's last rate cut and remains undecided for the December meeting. He's arguing that available data suggests more of the same for the economy. He joins other Fed officials expressing doubt over the need for easing in December.
We need to proceed and tread with caution, because I think there's limited room for further easing without monetary policy becoming overly accommodative. I believe policy right now is somewhere between modestly restrictive and neutral. We need to continue to lean against above target inflation while providing some support to the labor market.
When I look at both of those things, on balance, I think we need to remain somewhat restrictive to continue putting pressure to bring inflation down towards our target.
Matt Wacher, Apex CIO of Morningstar Investment Management, is still with us. Matt, just like that, we're back worrying about the Fed and what it will be doing, and a lot has to do with the economic fog at this point in time. Can the Fed still make a credible decision, you think, in December?
Well, I think, yeah, maybe that'll be the lasting impact of the shutdown, the no rate cut in December if the Fed don't have the data to decide. I'm sure they have many other data sources, but certainly that is throwing a lot of doubt into a December rate cut. It sounds like, the Fed are pretty split on the need for another rate cut. It's got to be a very difficult thing for Chairman Powell to negotiate there. Depending what his view is. But it certainly sounds like, especially with the lack of, data, that the rate cut is perhaps is not going to come in December. Our economists would, think that there probably is going to be a continued slowing in growth in the US. And that rate cuts will come eventually, but we think that, it's more than likely that there'll be a pause in December, we'd say, at this stage.
The thing is, it is still an economy that's pretty resilient, don't you think? I mean, inflation is still sticky. Exactly.
Inflation is still there. It's certainly still, if not a problem, it's still something that the Fed want to focus on. It's still well away from their target. And growth isn't slowing enough to really, and employment, it's not really slowing enough at this stage to really, whip the Fed into action, especially given they've had a few cuts already, and they'll need time to play through themselves, the recent cuts we've seen.
So what should smart money be doing? What has smart money been doing?
Well, I mean, I think we spoke about the AI hype trade. Maybe a bit of hype comes out of that trade if we're not getting the rate cuts that the market has been expecting. So maybe a little bit of the hot air comes out of some of those trades where valuations have been reasonably high, starting to push up towards historical highs in some cases. And so we've seen the markets over the last couple of weeks, and particularly overnight in the US, come off quite solidly. Particularly those, some of the big tech names, Nvidia down nearly 4%, 3.8%, Planeteer down about 6.5%. And we would say that this volatility is pretty normal. It's not. We think that the market's had a very, very good run since April, and that a bit of heat coming out of the market, especially in some of the areas that look stressed, isn't abnormal and could continue. But there are still opportunities. We'd say in US equities and in global equities, just where valuations aren't quite as stretched as some of the tech names.
So it is quite normal to get $1 trillion getting wiped out. Buy the dip then, Matt?
But it's not, yeah. Well, I mean, we'd be discerning in where we want to buy that dip from. We certainly think that part of the valuations in AI-linked sectors, they are stretched. There's probably more to come if they were to get back to more reasonable valuations where we would be interested in buying them again. We took advantage of the sell-off in April to step in and buy some of those big tech names. But we think areas like even luxury good makers, some other sorts of consumer names, Mondelez, Nike, we think is a very interesting opportunity this time with a range of different catalysts. And even, some of the global car makers like BMW, for example. Some of these names are quite depressed in terms of their valuations still. And they've got lots of catalysts, China, any kind of China turnaround would potentially see, say catalysts for some of those stocks to do well, tariff relief or even just normalization. Or markets getting comfortable with where tariffs are, would see another stock like Nike could get a leg up there. And then if we see consumers really starting to spend again globally, then we could see that some of these luxury names, some of these names like Nike or other consumer goods could do very well as well.
Matt, I'm not hearing Nvidia in there. Michael Burry,
no, we think,
betting against Nvidia,
we think Nvidia is a great
game
stock.
over.
we think they're great stocks. Look, we think that they're absolutely fantastic stocks. We had the Olympics last year. If you think about the high jump, even the best high jumpers in the world knock off the bar at some stage and have to reset. And we think that perhaps they're at that stage and they'll reset and they'll be able to jump over a higher bar at a later stage. But we think that they're getting close to knocking off that bar at this point. And I guess some of the names that I described, maybe the high jump bars are a little bit lower for them.
Are you anticipating a market correction ahead? The likes of Goldman, JP Morgan say that we could see a correction in the next 6 months to 2 years. I mean, that's a long stretch. What are you anticipating?
Well, I mean, we think, as I said, that there are opportunities in stocks to do well. We think that potentially some of the heat comes out of the market, whether that then turns into a correction, say a 10% downturn or something, is yet to be seen. But volatility in the markets.
Mark Morbius is looking at a 40% correction.
Right. Well, that would actually, that would be push us into a full-on bear market. I think that we don't necessarily anticipate that we're in a bubble at this point in time. It's not something that we try to call. What we really want to look for is where are the most compelling valuations in the market. And I've given you a few names where we think that there's actually some reasonably compelling valuations. But we do want to make sure that we're not invested too heavily in some of the likes of some of the areas where valuations are significantly higher. The NVIDIAs, the Planeteers. Doesn't mean that we wouldn't invest in them if we did see a correction, and we could take advantage of that. But we think that at this point in time, there are opportunities to invest, but we'd be cautious where valuations are higher.
How are you thinking about emerging markets? They say it is different this time around because emerging markets are now deeper.
Yeah, I mean, I think that emerging markets are structurally much more solid than they have been in the past. We think that certainly in some emerging markets, valuations are quite compelling. Latin America has some reasonably compelling valuations. In Brazil, for example. We think that China is a reasonable opportunity at this point in time, although it's come a long way from kind of this time last year. And so, that's reasonably good opportunity in China, but not as good as it was. And then I think that a place like India, we think there that valuations are still a little bit stretched, and we'd be more cautious investing there purely on a valuation-driven basis.
And in terms of the Indian market, any opportunities there?
Well, we think that it's all still a little bit expensive, even though a lot of the heat's come out of the market. We are having a look at it, but we think that valuations are still a little bit rich in aggregate there. You'd probably need to be much more active than what we intend to do.
Matt, great insights. Thank you so much for joining us. Matt Wacher of Morningstar Investment Management. Now, still to come on the show, we're live at the Citi China Conference with the bank's global head of research, Lucy Baldwin, is staying constructive on equities, even as she sees a volatile period ahead. Keep it here with us. This is Bloomberg.
I'm extremely optimistic on the domestic supply of homes because the strong demand is still there. It has been affected by the high interest rate. Now, I'm not that optimistic about the offices because that has been grossly overbuilt. So all of a sudden, you have a huge amount of supply. It'll probably take another 5 years before it will stabilize.
The overall economy, overall growth, has continued to perform reasonably well. We see Chinese growth over the next year running in the 4.5% to 5% range. And I think the key driver of that has been export performance, notwithstanding the tariffs and a declining market share in the United States. Export performance has been strong.
a lot of the headwinds seem to have more clarity. So remember, coming into this year, tariffs were kind of a main feature. Looks like we've landed kind of on most of the tariff framework. If not, it's work in progress. Net-net, the market is taking a lot of comfort that every country will land in some zone which will be palatable to the US and to that nation, and net-net life goes on. So I think those tariff headwinds, there is an element of kind of acceptance in the market and an expectation in the market that we will get to a good place.
Some of our guests this morning from the Citi China conference. And we're heading back there now. Bloomberg's Chief North Asia correspondent Stephen Angle is with our next guest. Steve.
Yes, Haslinda, our last guest this morning at this 20th anniversary of the Citi China conference is Lucy Baldwin, Citi's global head of research. Thanks so much again for having us here. So let's start in the U.S. because a lot of I guess the pundits are out saying, is the Fed going to ease or not going to ease? And it's tipping 50-50 right now. What's your outlook on that and how it relates to what we've seen as recent weakness in the stocks?
Yeah, no, fantastic. Look, it's great to be here in Shanghai. As you can see, it's bustling with 2,300 people behind us. So starting in the US, look, you're absolutely right. The December rate cut has gone from being a nailed-on certainty to now being about 60% priced in by markets. Our view is we will get that cut because of the weakness in the job market. We're seeing this notion of a jobless boom in the United States, and we think you'll get a couple more cuts in next year. So you've got this sort of Goldilocks scenario emerging, right? Inflation's under control. Obviously, we've had the shutdown, so the fourth quarter GDP numbers are likely to be softer, but you should see that bounce back in Q1. So Q1's actually setting up to be quite a strong quarter in the US for growth, with that pullback from the shutdown, plus some tax refunds and also some investments, again, incentives in the One Big Beautiful Bill. So I think you've got a few reasons to be optimistic that growth looks pretty good. You've got the cutting cycle of the Fed continuing, and you've got this backdrop of this rather remarkable AI boom still unfolding.
Still unfolding, not popping?
Well, we think still unfolding, right? You can debate where we are versus a bubble versus, say, the early 2000s, but I think the key difference for us is obviously the fundamentals of the majority of the companies that are spending the money, these big hyperscalers, right? They're obviously still buying back stock, paying dividends, they're largely spending all this out of cash flow. Very different dynamic to the early 2000s. I think investors are obviously right to put a lens on the returns question, because the capex that we're seeing, the infrastructure build, is far more significant than I think anybody had expected. And in truth, I think the monetization, particularly at the enterprise level, has been a bit slower to come through, which I think is what's causing people to ponder the return picture. But we feel very bullish that medium to long term, this is a massive growth driver, particularly for the US, but also for China, in terms of GDP growth and productivity growth.
So it is a jobless boom, as you said. Are the job cuts going to continue, and what does that mean for stocks as well? Because, again, to pay for the AI investment, they're cutting jobs.
Yeah, look, I think you've got a few dynamics in the job market, right? You've had labour hoarding post-COVID, so you're starting to see that kind of unwind. You've had the interest rate environment, right? We've had higher rates in the US. Okay, we're now cutting, but for a period of time, some interest rate sectors really struggled from a jobs market perspective. You've got this AI piece. Those are just some of the raw ingredients, as well as the tariff and policy uncertainty. But I think the AI jobs data that worries people is at that entry level, right? A lot of the studies that have come out, whether it's from us or some of the academic institutions, suggest you've got that real bifurcation, and that graduate cohort, whether it's in some of the technology fields like software or in customer service, that's where you're seeing that weakness. And that's going to be a big problem for society, both in the US but also all around the world, right, in terms of thinking about the social innovation and the policy innovation that is going to be required.
So I hate to take such a long-term lens, but 10 years, I mean, your counterparts over at Goldman are talking about EM's going to outperform the S&P 500 over the next 10 years at a annual rate of about 10.9% compared to 6.5% or thereabout for the S&P 500. Would you share that long-term horizon? You are overweight EM, you are overweight China.
Yeah, look, I think so. The challenge with the US market, which to your point, we are still overweight from an equities perspective for that sort of setup we talked about. The challenge is obviously valuation, right? It's in the sort of 95th percentile of its history. And although valuation is never a reason in and of itself to sell an equity market, it's a caution in terms of the potential upside from here because it has to all be done through this earnings growth, right? Whereas in contrast, if you've got the S&P 500 trading on 23 times forward, Hang Seng, although it's had a fantastic year up 30% this year, is still only trading on 13 times forward. So you can totally see why China and the EM complex offers an awful lot of growth, obviously from a GDP perspective, growing more rapidly. Lots of companies seeing that boom and growth in earnings, but at a much cheaper valuation.
So the cheaper valuation is what draws you to Hong Kong. The IPO market has been very hot. But again, the fundamentals, we just heard the data today. China's consumption trends are extremely weak, persistent deflation, continued property woes. What's going to drive it? Can it all be based on this AI boom?
Well, it's a really great question because, as you say, the property market is still problematic for sure, right? There's still got to be some sort of policy intervention here. Whether that looks like Europe and the West, I don't know, because I think obviously that playbook was more good bank, bad bank to clear that. Here it's taking longer to clear. As you say, the shift to a more consumption-driven economy is taking longer. Again, probably need a little bit more stimulus to come through. But I think, the market is obviously very weighted to some of these high-growth sectors now here in Asia. And I think that's really important, this sort of difference between the economy and the actual market and the main index, right? There's a big weight to the growth sectors, both in terms of market cap, but also in terms of earnings power. And it's really the excitement around seeing China dominate in sectors like AI and obviously robotics and other areas, right, in the way that they have with clean tech and the EV ecosystem. And you can see that potential for that to come through over the next few years and be a really meaningful driver of growth.
We've seen also politically de-risking. Yes, there's a truce between Xi and Trump in the U.S., but it's a temporary truce. And there's still a overall trend of de-risking. So how do you play that? Because also in your research notes, you talked about many of these trade-dependent economies in emerging markets and in Asia weathered the tariff regime pretty well.
Yeah. I think it's been a big surprise this year, the resilience, some might say defying of gravity, right? Because as you say, we came into this year very nervous about the tariff impact. You look at China exports, they're still up 8% this year, having been up 13% last year. Incredibly resilient, right? A lot of where that trade has gone is different. That supply chain reconfiguration has happened so rapidly and dynamically. The agility of this economy, I think, has taken everybody by surprise. But I think has obviously given that conviction that can continue. I think the 30th of October meeting between President Trump and President Xi was really important, right? Because I think it's the first time for investors you saw the two biggest economies on the world really start to negotiate together on two areas that are clearly very critical to both, rare earths and the supply of high-end semiconductor equipment.
They got some clarity, at least for 14 months, till the end of next year, and they brought the temperature down. What about gold? Obviously, the temperature has been hot, and then it cooled off a bit, but you're convinced that there's going to be a run-up again.
Yeah, and I think to sort of summarise on the tariff piece, that stability and predictability is going to help a lot of things, right, in terms of the appetite for risk assets. So in contrast, gold, right, was a go-to asset. It's been up 50% this year, up over 100% in just 2 years. But I think that debasement trade has run a lot quite quickly. Structurally, long-term, we're quite bullish. I think the potential for crypto ETFs, the broadening of the stablecoin market, all of those dynamics help, as well as, of course, the central bank buying, which will continue. But I think what we've probably seen is a big move very quickly. So we'd be more cautious near term, and then structurally longer term, we'd look to come back into that.
There's a million things we could talk about, but I want to ask you finally on Japan. They've had obviously a stimulus-driven, pro-growth Prime Minister in Takaichi. You have the weak yen at 150 plus, and there are lots more foreign interest in the Japanese market. The Nikkei is up 30% this year. What's your take on Japan?
Yeah, Japan is the one economy, if we look at 30 major central banks, where we're expecting to see hikes. So it's a bit of an outlier in that sense. I think investors are still fascinated by the ongoing corporate reform agenda, which is a huge support in terms of earnings growth for the equity market. So again, I should say a lot of interest in Japan, and I think it's one to watch in terms of the currency dynamics as we go into next year.
Yeah, that's right. You expect the yen to strengthen?
I think,
it's got to, right?
I think, I tell you what, it's really tricky to know what the dollar's going to do, so you've got to take your dollar view first.
That's right. All right, Lucy Baldwin, thanks so much. Global Head of Research at Citi. Thanks for wrapping up our coverage this Friday morning.
Pleasure to be here.
On Bloomberg Television. Haslinda, back to you.
That's right, and the dollar seems pretty resilient. Stephen Angle, thank you so much for that great coverage from the Citi event. Now, we're also watching the Korean won as South Korean authorities pledged to take steps to stabilize the currency after close discussion with the National Pension Service and major exporters. For more analysis, let's bring in Bloomberg Emerging Markets macro strategist Marcus Wong. Marcus, the question really is whether this intervention will work. With this announcement of the involvement of the National Pension Service, do investors now see a possible turnaround in the currency?
That's a brilliant question, Haslinda. And I think we just look back to January this year. I mean, we recall, there was a rather huge sell-off in the won in December last year after President Yoon, with his failed martial law decree. So subsequently in January, there was the announcement from the National Pension Service that it will come in with the strategic hedging in mid of January of this year. It was estimated and they would spend around $50 billion selling $50 billion to essentially support the currency. It's interesting to point out also that the point of the announcement was around the 14.50 level for the Korean won, which is essentially where we are right now. So you could say that that's a kind of a number that is at the back of possibly the authorities' mind. So what we can say from then is that after the announcement from the National Pension Service, the won actually obviously rose, and later subsequently actually outperformed all Asian currencies in January. Of course, later this performance subsided since then. But what I would say is that this intervention from the National Pension Service is something to be on the lookout for, and we've also seen some investors and strategists actually upgrade their calls for the won after the National Pension Service came in with the announcement.
In our conversation with the Bank of Korea governor, he talked about how external factors were weighing on the won. I'm just curious what your take is on that, and whether the gains today are sustainable on the back of what he said.
Well, that's a very fair point, right? So what I mentioned was whether the won will pull back from levels. I think that's what the authorities are concerned about. So interesting to note back in January that after the NPS made the announcement, the won outperformed all Asian currencies. But this time around, I think the outlook is a bit more clouded. You have a Fed that is potentially may not cut rates in December. We saw the overnight rhetoric from some Fed officials. It seems they are quite reticent, they're quite cautious about whether they should, essentially cut rates in December, especially in lieu of the lack of US data that's forthcoming. So, of course, if the Fed turns out to be a bit more hawkish than expected, the won, which is a low yielder in the region, will definitely be impacted. Another thing to point out is, of course, we've seen a lot of the won weakness due to the fact that, local investors, retail investors, more important investors have been, buying US stocks and bonds in big amounts. I think the outflows in October was actually a record high from Korean retail investors into US assets. So, of course, if these structural underlying themes stay the same, we could, of course, potentially see, won staying weak moving forward. But it's fair again to say, I think, after today's announcement, and if, the National Pension Service comes in as robustly as it came in January, we could, see won pull back from, the weak levels that we've been seeing over the past few weeks or so.
Is there a sense that the BOK has decoupled from the Fed?
Well, with the latest data coming in, traders have essentially turned slightly more hawkish for the Bank of Korea. So in a sense, have they decoupled? I think they are definitely not as dovish as they were a few months back. And we are actually seeing the same thing from the Fed, essentially, that the Fed may not be as hawkish we may not be as dovish as expected. So on the rates differential side, whichever central bank begins cutting rates first, then that, I guess, would tip the balance in favor of the opposing currency as a result.
The won higher by 0.5% versus the USD. Marcus, thank you so much for that. Bloomberg Emerging Markets macro strategist Marcus Wong there. Still to come on the show, China's economic activity cooling more than expected in October, raising calls for fresh stimulus from Beijing. We'll dig into the numbers next with SocGen Greater China economist Michelle Lam. Keep it here with us. This is Bloomberg.
Industrial production numbers came down also below 5%. And relative to last month, it is quite a notable deceleration. It's kind of not a surprise given that, exports was a disappointment. So probably this number is going to be a bit lower than expected. But that said, it didn't come down to 5, but instead even lower than 5, implying that domestic demand is indeed pretty weak.
And that was Helen Chiao from BofA Securities discussing China's latest economic data. Now, those numbers show economic activity cooling more than expected at the start of the fourth quarter. A slump in investment and slower growth in industrial output, adding to sluggish consumption. Let's get perspective from Michelle Lam, Greater China economist at SocGen. Michelle, it does seem like, the market's shrugging off the numbers. It's just a matter of time before stimulus will trickle through. Is that a fair assumption?
I think that's the case. If you listen to the policymakers' announcement recently, they still sound quite confident that the growth target of 5% this year will be met. So they've already done some measures, such as the NDRC announcing that they will issue the 500 billion structural policy tools, and the distribution was already completed in October. But so far, we haven't really seen it in the credit data and also not the fixed asset investment data released today. But I believe that over the coming months, the investment should pick up a little bit to make sure that the government will hit the growth target.
The thing is, Michelle, sometimes it is about optics, and the numbers today could impact consumer confidence further.
Exactly. And I think what is most concerning to me is the house prices. And actually, if you look at the house price data, the decline actually intensified even further in October. And if you look at the housing sales, it's also plunged pretty notably in October, also because of the base effects that we saw from last year after the September policy pivot. So I think there's a danger that the house price expectations just keep weakening, and that will feed into very weak home sales. So that's just not really positive for the consumer confidence. And that means that the consumption recovery in China is still going to be pretty challenging.
And the messaging so far from the PBOC is that it is willing to wait. And some are suggesting that PBOC is possibly close to the end of the easing cycle. Is that the right move from the PBOC?
Of course, I think looking at what's happening in the Asian markets recently, I think for Korea, Taiwan, for instance, I think there's some concerns that maybe we are close to the end of the easing cycle, but I think China is still going to be different. But of course, I think for the PBOC, there are a lot of issues that they're focusing on, such as the bank profit margins, which has been compressing in recent years because of the interest rate cuts. And I think there's also an argument for the PBOC to consider that actually if the government wants to accelerate anti-involution, meaning that they want to reduce supply in the sectors with too much excess capacity, actually lowering the interest rates may not really be beneficial in terms of facilitating this campaign. So it's really about channeling the financing resources to the very productive sectors. So the PBOC may still prefer to use targeted measures to improve the credit allocation. So I think on that, they have to weigh up the pros and cons of whether they should cut interest rates much further. But over next year, we still expect 2 interest rate cuts of 10 basis points each time from the PBOC, just because that I think the property market is weakening so much, and they really need to lower the financing costs to make sure the house price expectations are stabilizing and to support the home sales.
And Michelle, when it comes to the Chinese yuan, has been pretty resilient. In fact, we're seeing the biggest weekly gains versus the USD. I'm just wondering whether that is the right approach to take, given that the economy is weak, because a weaker currency would be helpful, especially for Chinese exports.
I think from the policy perspective, maybe a weakening CNY. Well, the argument for that is that you will weaken the CNY to support the exports. But from the policymaker side, well, China's exports are already so competitive. And exports are already growing so quickly this year of 6%, even with the U.S. tariffs. So does China really need an even weaker CNY to rebalance the economy? So maybe the government just thinks that actually maybe it's not that helpful. But of course, at the same time, if you talk about CNY appreciation, of course, that is going to hurt the exporters' revenue. And also too much or too quick of a CNY appreciation may also will cause market volatility. So I think they're going to manage it in a very gradual way. So I think in the near term, stability is still key. And also, I think considering that the recent successful U.S.-China trade talks, I think that's also really improving the market confidence that the trade truce is going to last for a year. We will see what happens after a year or so. But I think China also demonstrates that it has a quite successful leverage over the U.S., given that they're depending less on the U.S. Export market. They're also buying more soybeans from other countries, so they are reducing the dependence on the U.S.
You talked about how China will manage its currency in a stable way, but in terms of yuan trajectory, you can expect it to grind higher from here.
I think so. I think our house forecast for that is to go to around 7%, 7.0 in 2026. But I think what's going to happen with the Fed is also very important because, a few weeks ago, we learned from Powell that maybe the interest rate cuts, the pace may not be as quickly as market expecting. And in recent weeks, we also seen pretty quick repricing of the Fed rate cuts. So I think the dollar still matters.
Michelle, thank you so much for joining us today. Have a great weekend ahead. Michelle Lam, Greater China economist at SocGen. Let's do a quick check on where Asian currencies are at this point in time. We've been talking about a resilient dollar, but that's taken a bit of a breather right now. We have dollar yen currently at 154.52 and Chinese yuan at 709.46. Still ahead on Insight, we turn our focus to India. We'll talk about opportunities in the credit markets with Jairam Sridharan of Piramal Finance. Plus, a closer look at the nation's flooding and infrastructure challenges with Green Globe. More to come in our next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Asian markets trading lower after data showing China's economic activity cooled more than expected in October. Retail sales gained 2.9%, slowing for a fifth straight month in the longest such streak in 4 years. Other categories, including fixed asset investment and industrial output, missed estimates, while the decline in home prices also worsened. Let's get back to the Citi China conference in Shanghai, and our chief China correspondent, Stephen Angle, is there. And Steve, you know what? When you take a look at the market reaction, has been pretty muted.
Yeah, that's right. And I guess that's to be expected because the numbers reflected what we pretty much already know about the Chinese economy. Consumption is weak, to say the least. The property market is still an ongoing drag. There's persistent 3+ years of deflation. Yes, the CPI numbers this year, or in the last month in October, were better than expected, but probably popped up by the aberration of the October week-long holiday. So, again, everything that came out today with that raft of numbers suggests what we already know. Going forward is the expectation of stimulus, because we've just also come out of the closed-door meeting of the fourth plenum where policy leaders essentially mapped out the next 5-year plan. And also, of course, we're going to have the blueprint going forward for the National People's Congress in the first week of March, which will set, of course, the marching orders for the provinces to meet certain growth levels. So we can probably predict with fair amount of certainty that between now and through the National People's Congress in March, we will get more measures of stimulus. But again, yes, the backdrop is a weaker Chinese economy with the prospect of stimulus coming forward. Now, again, just here at the Citi conference, China conference, we talked to a raft of economists. We've talked to the top leadership, including Jane Fraser, the chair and CEO. And she actually scolded me a little bit, Haslinda. She says, your narrative is wrong on Citibank. We are going front foot forward and expanding and investing rapidly in China. This is my conversation with colorful Jane Fraser.
The recent truce has brought some much needed and welcome stability here. I think we're in a position now for both sides that wanted to have a period now where we can move ahead and have a more stable relationship between both of them. It's transactional, but it's in both sides' interests. And we see our client base navigating this well.
Yeah. What's your vision for the China market as it folds into your overall restructuring plan as well? You're now chair and CEO. First time that those two roles have been joined in a couple of decades. Clear mandate to carry out your vision going forward. What does that look like when you did exit your consumer banking business here, like you did in many markets around the world? You also sold your retail wealth management portfolio to HSBC. You got out of an investment bank JV with Orient Securities, I believe, and you have an outstanding license application for your wholly owned JV in securities.
So Citi has been in China for 124 years. We have a landmark building here in Shanghai. And what we have done is focused our strategy and grown. We are following our international clients around the world. We're seeing them with renewed interest and focus in China, as we talked about. And then we're seeing the Chinese companies innovating at pace and also looking at expanding internationally. So we've been growing rapidly here with a more focused strategy.
This also very bullish on India, magnificent opportunity there.
He's biased.
Might be a little bit biased, maybe. But again, what do you hope to get from those markets as it fits into your restructuring plan and the vision that you just talked about?
The growth plans that we have going forward, because we are on the front foot. I cannot stress that enough. You can see it in our results. So all of our businesses, we're taking share, we're growing very quickly, and our returns are improving. So as we're looking forward, it's growth. Let's take India. Citi is larger in India today. We are the largest foreign firm by revenues in India. When I look at Korea, where I was just at, that's another market where we were the first foreign bank to open the doors in Korea. And we have a very strong position there supporting multinationals and clients. So as I look around the world, it's becoming more focused on diversification. There is also a focus on reinvention. What we are doing is helping provide the strategic advice. We're helping provide the financing and structuring and arranging that. And we're also helping manage the supply chain reconfiguration. We're helping with the hedging in foreign exchange, interest rates, because volatility is a feature. It's not a bug of this system.
Through your restructuring, you had to get rid of the retail side. And are there other areas that you would like to divest? I know
you have the wrong story. Citi is about growing. We're very
front foot forward.
We are very
yes.
clear on our strategy, and we're moving onwards.
I only ask because, again, the Russia situation is a little bit different probably than your overall strategy.
Yeah.
We just got word that Vladimir Putin approved the sale to Renaissance Capital of your bank in Russia. Probably something that you've been wanting to do for a while, but it was held back.
We have been winding down, as many companies have been, the franchise in Russia. We were waiting for the final approval to be able to sell. We've got a couple more to go to Renaissance, but it's a tiny business. So it's in the grand scheme of where Citi is, where we're investing, and what we're doing. It would be good to get that done, but it's not critical to the firm's strategy going forward.
Let's talk about the outlook in the United States right now as we head into 2026. We saw the market reaction overnight. Simply, we're seeing that the Fed's equation, the bets for possible easing coming up are now 50-50 or is still below that because of the specter of inflation. What is your outlook for Fed action going into the new year and the specter of inflation rising?
Look, I don't think we're out of the woods yet, and there's a sense that there may be another shoe to drop. It could be in tariffs or in the labor market. It could be in the asset prices that are quite high in the States. But all of that said, we're quite optimistic about 26. The challenge for the Fed right now is with the government shutdown. We all have a dearth of up-to-date data, which we could do with. It's hard to make these calls of exactly what's going on whilst we're waiting for the information. But as we look further out into next year, I think the resiliency of the corporate balance sheets, the strength, companies leaning in to innovation, investing in AI. There is I think the doomsdayers will be proven wrong.
We're a couple months out now from when we had concerns rise about, I think there was one of Tricolor, the subprime auto lender. There were failures. There was concerns about non-performing loans. What does your balance sheet look like as far as that, and where is your worries lie?
Our balance sheet is pristine, but I think part of that is because it's very heavily investment grade on the corporate side. We're over 80% investment grade globally, and when we look at the consumer side, it's about 86% prime. So we tend to see the most resilient, healthiest parts of the economy on the balance sheet. All of that said, we haven't seen a thing that is concerning us. The consumer in the States is being fiscally responsible. Companies have been building up some more cash, either for a rainy day if it proves necessary, but most of them for investment. And they're acting from a position of strength. We'll keep an eye on the labor market. We'll keep an eye on some of the areas of mid-tier players in private credit and the like. But as far as we're concerned, that second, third order effects, the bank's not seeing anything that we're worried about.
Are you concerned by what some say maybe bubble forming in AI? We talked about the advantages of AI, but how much of a bubble or overheating?
I'm not sure if we're just in with a lot of our tech clients on the West Coast. I don't think anyone was ready to say that it's a full-on AI bubble, but no one is saying that there aren't some real pockets of let's call it the British understatement of frothiness in the market. It's more around the edges. What I found interesting is we can see a lot of the demand for the infrastructure build that's going in AI and the energy for the next couple of years. Where you saw some opinions diverge was in the 3 to 5 year period, could we be in danger of overbuilding? But no one's feeling that for the big investments that are going on at the moment for the next couple of years. So I think on that one, certainly some pockets of frothiness there on the valuations, but the core infrastructure investments are important, and as we're seeing in our own bank, and I think many companies we'll start getting some of the productivity benefits coming through. But the scale and the pace of investment is unprecedented, that is for sure.
So obviously, Jane Fraser there, the chair and CEO of Citi, is quite bullish on the China market and also on the AI situation, which is going to fuel, according to the head of global banking, a boom, continued boom in M&A, as Citi has, according to the latest Bloomberg rankings of M&A advisory, risen to number 4 on their advisory work for cross-border deals.
Love it when she said that her balance sheet is pristine, right? It shows a lot of confidence. I'm not sure how many CEOs can actually say that. You know, the conference that's happening there, Steve, is against a backdrop of a lot of uncertainties, right? We talk about the Fed, the trajectory of the US dollar, AI, and of course the US economy in particular. I'm just wondering, what are some of the key takeaways? What's the sense on the ground that you're hearing from participants there?
Well, confidence is one thing. Yes, we've come out of a bruising trade war with the United States. China has, and not even out of it yet. The two countries are probably still de-risking, not necessarily decoupling, but de-risking going forward. Because, again, as Nicholas Burns, the former U.S. ambassador to China, told me in an interview earlier this morning, a lot of the stresses are still there between China and the United States. And Trump and Xi did not sign a traditional trade deal, if you will. It's a lot of good faith built into this de-escalation and bringing down the temperature to allow businesses to go forward with at least a clearer roadmap for the next 14 months, unless, of course, there are snags along the way, which there likely will be. But at least the two gentlemen have lowered the temperature. And that is something that I've heard consistently throughout my interactions with the people here in Shanghai. That's a good thing for business. They want clarity. They want de-risking. But going forward, again, the AI trade is still front and center on the minds of people here in China. There's confidence that China can go forward, does not necessarily need the U.S. technology. It has spurred the opportunity to invest in homegrown technology. That's why, we had Lucy Baldwin just in the last interview, the last hour. She's the head of global research for Citi, saying they're overweight emerging markets. They're overweight China. They see the AI boom here in China. I'm not talking Silicon Valley. The AI boom here with that so-called DeepSeek movement giving wings to the markets here.
Great work there in Shanghai. Chief North Asia correspondent Stephen Angle, thank you so much for joining us today. Now, here's one market that Jane Fraser was also excited about. She talked about how they're bigger in India today than before. I'll look at Indian markets as Prime Minister Modi's alliance leads in the majority of seats in Bihar state elections. After early vote counting, the Sensex currently under some pressure, down about 0.1%. Let's bring in Bloomberg's government reporter in South Asia, Swati Gupta. What are we looking out for, Swati, as the vote counts continues?
So it's still very early in the day. The counting will go on through the day. But yes, the early numbers are showing that Mr. Modi's alliance is leading in the elections. And a win for Mr. Modi at this point would be quite crucial considering the last few turbulent months that he's had. But we still have to wait and see, because in Indian elections, seats flip very quickly as you go along.
How significant would a victory be for the Prime Minister?
So Mr. Modi has had quite a few difficult months. India had a conflict with Pakistan, and then the ongoing trade deal, which is not getting finalized for the past few months, plus the uncertain trade tariff policy that has been going around makes it very difficult to predict India's growth and incoming investments. So a win, even on a domestic level, would make Mr. Modi look stronger than maybe the last 4-5 months of turbulent policy changes have shown that he's weak. So it is significantly crucial for him. Plus, I think the party wants to show that politically it is in a stronger position after last year's national election, where his party lost its majority for the first time in a decade.
And of course, the significance is that it is Bihar. Bihar has a massive influence in national politics.
Yeah, Bihar is kind of a microcosm of how India is, the northern part of India is represented. So the politics that run in Bihar would be incredibly important for upcoming elections in the next year. Winning or losing there will give any party an edge for the coming elections. And Bihar sends a significant number of parliamentarians to New Delhi. And the regional party right now in power there is throwing outside support to Mr. Modi's BJP in the parliament. So a loss in Bihar for Mr. Modi would create some tension and some uncertainty here in New Delhi.
What's the sense when it comes to the opposition and how its campaign has been?
The opposition so Bihar is largely ruled by regional parties. So the national parties are members of the alliances there. And somewhere the opposition has been campaigning on the fact that Mr. Modi's party and the Election Commission have committed voter fraud to some extent. These are allegations that both the government, the Election Commission, and Mr. Modi's party have denied. But they have largely campaigned on this. So, and they are also campaigning on unemployment, which is now a major issue in India. They're campaigning on how they will bring more jobs into Bihar, how they will improve the lives of people there, considering that Bihar is one of the poorest states in India and unemployment is a huge issue. Those promises could yield a certain amount of votes for the opposition.
Bloomberg's government reporter in South Asia, Swati Gupta, thank you so much for keeping us updated. Now, still ahead this hour, as India's financial sector draws growing interest from foreign investors, we speak to the MD and CEO of the recently listed Piramal Finance. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. PayPal and MasterCard-backed Pine Labs just made its trading debut in Mumbai after raising around $440 million in an IPO that saw strong investor demand. Pine Labs operates across Asia, including Singapore and Malaysia, offering merchant payment systems such as point-of-sale terminals. Now, despite the losses today, investor appetite for Indian stocks has picked up, especially after the October drop in India's consumer inflation to a record low. The benchmark Nifty index is edging closer to its record hit in September 2024. Now let's bring in our senior editor, Manika Doshi in Mumbai. Manika, we're seeing an AI-related stocks meltdown pretty much across global markets today. Could India come out unscathed if the bubble bursts, given that foreign investors have been fairly down on India this year?
Well, Has, that's a really interesting question. And let me put it in the shortest possible answer that I can give you. Yes, India could potentially be a beneficiary. And we've seen what is called the AI hedge trade already play out in a wee bit in India's favor, because really India has absolutely no AI play to boast of. Now, this country will definitely be one of the world's biggest consumers of AI, but so far we have no hyperscaler stocks and no significant data center capacity stocks to talk about. So yes, if there is a burst in the AI bubble, there's a good chance that people will look for growth elsewhere in the world, and India potentially presents that opportunity. And in fact, that allows me to talk to you about, Neelkant Mishra, who joined us at Bloomberg's first subscriber event. Now, most of us think that, it's been a terrible year for India, what with Trump's tariffs, the US trade deal still pending, China hostility, middling growth. But Neelkant Mishra disagrees. He says, in fact, and I quote Has, the real story of India this year is how the reversal of monetary tightening and the end of hard fiscal tightening is driving a cyclical recovery in the economy. Mishra is the chief economist of Axis Bank and also a part-time member in the Prime Minister's Economic Advisory Council. Listen in to what he had to say.
I've been expecting this time correction for a while.
How long will it continue? Since you got it right with the expectation.
So you get it wrong, you get it right in market forecast, you hit and miss. So, but I think that in the next 12 months, the 12-month forward earnings will start to rise because as the economic recovery comes in. Remember that in the last 12 months, India is among the worst markets in terms of earnings revisions. So we saw a 12% cut in earnings, which is among the worst in large markets. And as a result, the market remained stagnant. Everyone else went up 20%. We were still stagnant. Then our weights in various benchmarks fell. A lot of passive funds had to then pull out of India. So all of that has happened, but that's behind us. As the economic recovery starts to come in, and when I was in the US and UK meeting investors, I was shocked to see that the short-term investors were calling India an AI loser and Taiwan and Korea the AI winner, and therefore, India is a funding short. That you short, you get the money and you invest somewhere else. And so I think that will start to change as the roots of the economic recovery start to show up, or at least the momentum becomes more visible, and people realize that the improvement in October and so far in November was not just because of GST and it's going to last. As that starts to become more convincing, I think foreigners, at least on a relative basis, will start to come back.
All right, so Mishra is anticipating more than 7% growth, and one of the biggest beneficiaries of a fast-growing economy is the country's financial services industry. Joining us this morning, Jairam Sridharan, Managing Director and CEO at Piramal Finance. Jairam, thanks very much for being on Bloomberg. Your industry is being buffeted by two big changes. One is a revival in growth and therefore a revival in credit growth, and then a surge in deal activity, especially foreign investment, and potentially the merger of small public sector banks. Which one is the most significant trend according to you, and how do you see it play out?
Good morning. Thanks for having me, Menka. As always, fundamentals trump deal activity. So what's fundamentally happening in the economy in terms of growth, credit build out, market structure is always going to trump the kind of, we are excited about the deal activity, don't get me wrong. There's a lot of interesting things happening, and certainly long-term investors seem to have discovered India as a potential source for deep investing. And that's a great thing. But the fundamental growth in the economy, I saw Neil Kant speaking a little bit earlier in your piece about kind of earnings growth that he expects to start seeing, and I fully agree with the points that he was making, that when you see the fundamentals of the economy, and when the economy goes back to chugging along at 7.5%, that is always going to drive credit. Over the last 50 years, lending in India has grown at a nominal rate of 15.5% annualized over a 50-year period. That's an incredibly long period for mid-teen growth to be maintained. And however, in the last few years, the last 10 years, that rate has come down to about 11%. So nominal growth coming back, and that resulting in greater credit growth is always going to drive our sector a whole lot more than the deal activity.
Yeah. Jairam, can you talk us through what specifically you expect over the next 6 months to 1 year, and which pockets of the economy you expect some of this growth to come from? Is it retail lending? Is it lending to small enterprises?
See, if you look at the Indian economy over the last few years, there have fundamentally been two main engines that have driven the economy. On the one hand, there is government spending, and on the other hand, there is personal consumption expenditure. Those are the two engines which have actually driven the economy a lot. What has happened over the last year or so is government spending as an engine slowed down, starting from just before the elections, the general elections, and then the election results coming up with slightly surprising and soft results on the present government, and then them having to try to find their own feet, etc. So over the last calendar year, there was a 6, 8, 9 month period in which you saw government spending go soft. And that meant of the two engines that the economy is working on, one of them has gone soft. And that was creating some problems for the industry. That has now started coming roaring back. And that's always going to be a great thing for the economy. Consumption is patchy, and we're seeing some pockets of softness in rural India, etc. But mid-market India is doing really well. Both the large cities and rural India are probably kind of still a bit soft, but middle market India is doing really well, and we are seeing a lot of pickup there. You've seen some of the activity that's gone on recently in terms of car sales,
right.
And that shows you that consumption and that ability to invest small ticket capital expenditure on the part of the household is very much back.
Jairam, you talked about this massive growth. I don't want to be a party pooper, but could lenders be underestimating credit risk on the back of that?
If anything, Haslinda, I feel lenders have been over the last year overly cautious. I think the country did go through a little bit of a credit risk jolt in the middle of last year. And what that did is a whole lot of people pulling their hands back, a whole lot of lenders bringing down lending. The sector level kind of lending growth has come off starkly, particularly in unsecured credit, in personal loans, small business loans, etc. Things have come off pretty starkly, and in fact, in some of those sectors, YOY growth has turned negative. And this is a reaction to what I was saying before, which is government spending slowdown and resultant increase in credit risk that the sector saw. Everybody reacted very, very quickly, and that's also leading to a very soft sectoral credit growth right now. If you see credit growth as of today in the country, that it's running at about 10%. For a country where currently nominal growth is also about 10%, which means a credit growth to GDP growth ratio of 1:1. Historically, this has been 1.25 or 1.3:1 in India. In fact, in many developing economies, the argument made is that credit should grow at 1.5 times nominal GDP growth. But India currently is growing at 1x nominal GDP growth. That shows you the conservativeness that has seeped into the lending sector.
Jairam, speaking of optimism and excitement, we know that large foreign banks are getting really excited about the Indian financial services sector as well. What do you make of that trend? Is that likely to continue? What do they bring to the table?
See, India is overall capital deficit. And in particular, we are deficit in long duration capital, long tenure capital. Indian capital expenditure is largely funded by banks, who themselves are largely funded by consumer deposits, which are 3-year tenure. And an argument that I often make is that you cannot build a 30-year country with 3-year deposits. That doesn't work. There is a complete mismatch here. So India needs longer gestation capital. Pension industry, insurance industry, etc. in India, which do tend to be long gestation capital, have generally been small compared to the needs of the economy. So what are the sources of long duration capital that can get unlocked? There are two main ones. One is domestic promoter capital, a lot of which is locked up with domestic promoters. And two is international capital. The government clearly over the last year or so, working with the regulators, has chosen the latter. The government has said, you know what, we're going to find ways to attract long-term capital into the financial services sector to help us build this sector, which is kind of foundational for the rest of the economy, right? And to that extent, a lot of the approvals, the spate of which you have seen come over the last 6 months, are very welcome in that they are a form of a large ticket, extremely patient international capital entering into the foundational sector of financial services.
Jairam, but I'm sure that this will change the competitive landscape. Really, what kind of pressure does it put on the rest of the finance services industry like your company? And are you also looking for external investment?
So, India needs many more financial services providers, and we can deal with a whole lot more people coming in. It's little appreciated that over the last 10 years, the number of banks in India has gone down, not up. And that reduction in sort of competitive intensity is rarely spoken of. Why has it gone down? It has gone down because the government in particular has taken on a big charter of merging public sector banks. And where there used to be 25 public sector banks, there are currently 10 and probably will be lower number going into the future. And as that consolidation has been happening, that consolidated group has been losing market share, which shows you that competitive intensity is not increased a lot. India needs many more providers of credit and capital for the economy to continue growing.
That point is well taken. Jairam, are you looking at, or are any investors quoting you? Because I know there is significant heightened interest in the non-bank financial space as well.
Yeah, we are very popular right now, and we're getting a lot of interest.
You want to give us some names?
No, I'm afraid not. But it's it's a thing that is it's a trend that's very, very popular right now. And we are one of the big large names that's out there, and we've kind of
if you can't give us a name of who's quoting you, give us a timeline for a deal announcement.
That's even harder. See, the way I'd say this is there are families of players that are showing interest, and it's similar to what you've seen recently. Large sovereigns, sovereign funds, long duration, pension capital. Asset classes or families like that, and of course, international banks who want to make a presence in lending in India. Those are the kinds of families of investors who are showing a lot of interest. At Piramal Finance, we are super well capitalized right now, and we are growing at upwards of 25% annualized. So we are quite happy where we are right now, and we'll let our current story play out a little bit more.
For the moment, Jairam, right? Jairam Sridharan of Piramal Finance. Menaka, please stay with us. Now, coming up, a new study reveals Mumbai's flood toll on lives and the economy is far worse than official records suggest. The report's co-author will be joining us next. Keep it here with us. This is Bloomberg. Mumbai, India's financial capital, is pouring billions into new highways, train lines, and airports. Yet, every year, the city is still brought to its knees by relentless rains and floods. A new study reveals that severe flooding in Mumbai claimed more than 2,700 lives annually over a decade, while causing economic losses of $1.2 billion each year. Deaths were linked to drowning, electrocution, and disease, with conditions like diarrhea and tuberculosis worsening dramatically during flood seasons. Malika, we're talking about a mega city, mega money, but it has to do with those mini drains, right? Drainage system that's pretty much stuck in the past.
Yes, and this data that you've pointed out has, shocking as it is, speaks not just to the problems in Mumbai, but across big cities in India. It's a combination of rapid urbanization, poor urban planning, and then, of course, extreme climate events. Interesting to know what the methodology behind this is, but putting numbers to the size of this problem which is not frequently done in this country, will hopefully galvanize some official action. Though I have to say, I don't stay very optimistic about that.
Yeah, you got to wonder why, though, right? This is one country that's, committed a lot of resources to even the space program, and you're wondering why they're not making this a priority.
It's an excellent question. I live in India and I don't have a real answer, but I can give you the long version of this. I think it has to do with devolution of power politically. And what has happened is that unfortunately power has coalesced at the center and at state governments, and cities don't have enough empowerment to be able to determine their own futures because they're really cash cows for state governments and central governments. And I feel like that's at the core of the problem, the administration of cities. But, that could take me 3 hours to talk about it, and I don't want to bore you with that. That seems to be the big political problem here.
Manaka, stick around because I want to bring in Archana Patankar, founder of consultancy Green Globe and co-author of the study. Archana, good to have you with us. Is this a lack of political will?
Thank you so much for inviting me on this program. I wouldn't term this only as a problem of political will. I think we have to break this into two parts. One is what the city administration can do, and the other is what the citizens can do to improve the situation. So as far as the city administration is concerned, in the aftermath of 2005, and I'm just talking about Mumbai right now, because our study deals with Mumbai. And we know that it's a very large mega city housing more than 12 million people, with 6 to 7 million people traveling into the city every day for work. And for this, magnitude, we have the city administration, which has been trying to do something as far as flooding is concerned, especially in the aftermath of the 2005 event. 26 July 2005 was a record-breaking event as far as the rainfall is concerned. It's termed as a 1 in 200-year event, and it kind of brought the city to a complete standstill for almost 3 to 4 days in the aftermath of that event. Since then, there have been some infrastructure upgrades which have happened. So, for instance, the city has tried to build an early warning system. We are trying to do the vulnerability mapping for the city. Stormwater drainage upgrades are happening. Flood-proof infrastructure is getting developed. But at the same time, we also need people to follow instructions from the administration, help with the waste management, which is actually something that is, clogging drains. So I think
what you're saying, Archana, is that they have tried, but the measures have not really worked. Why is that, and how do you take it forward? How do you resolve this issue?
Yeah. So one reason is that this is kind of a catching up game because over last 2 decades or so, we find that the rainfall pattern in the city is completely changing. So the intensity of the rainfall, the duration of the rainfall has changed completely. We have more extreme rainfall events happening with more frequency year after year. So even if, your stormwater drainage system has been designed for a particular amount of rainfall to occur over an area over the next, say, for 15 minutes to half an hour, that design may not be enough considering how the climate change is happening and how the rainfall situation is worsening. Which of course means that we have to keep on upgrading the system.
Yeah.
We have to have these better downscaled climate models which tells us what kind of rainfall pattern are we going to expect in future. And then accordingly, redesign our systems.
Yeah. Did you use another city as a benchmark, Archana, so that you could sort of, compare how Mumbai has coped with this versus, let's say, any other city in India or across the world that may have done a more competent job?
Not for this particular study. For this particular study, we have restricted only to Mumbai. But in my previous studies, I have looked at Mumbai, I have looked at Bangkok, Manila, and tried to compare with what maybe cities in the developed world have done. And we find that it is basically the constant upgradation of infrastructure, which is going to help us to deal with flooding problems. And it's not just constant upgradation of infrastructure, but we need more studies to really tell us what do we expect in future. And this is where maybe some of the, bigger cities with better infrastructure have tried to achieve. And I would also say that in the last 5 to 6 years, you see that even for cities in the developed world, which have a better infrastructure than us, you see that flooding is becoming a chronic problem.
Right.
So which means somewhere the design of those cities also needs to be upgraded.
Archana, until that happens, I'm just wondering what can be done to protect the most vulnerable, the slum dwellers. What's being done currently, and what would you like to see?
Okay. I would say that slum dwellers or informal settlements are a direct result of rapid urbanization. We already have 36% of our population staying in cities, and it's growing. The rate of urbanization is very rapid. So which means more and more people are going to come and try and live on the fringes of the city where, they would not have equal access to sanitation, healthcare, and housing, and so on. Now, we cannot obviously prevent people from coming into cities because they are coming for livelihoods. But what we can do is we can create better infrastructure. We can create the metropolitan areas around the main city where there is better housing for people,
Archana?
there is access to other infrastructure. Yeah.
We have to leave it there, Archana. Archana Patankar, founder of Green Globe, and our very own Menaka Doshi. That is it for Inside Horizons, Middle East and Africa. It's next. Keep it here with us. This is Bloomberg.